You see the grocers restaurants, right?
Hmm.
Yeah.
All right. Connor, you can kick us off.
Yeah. So introduce the
All right.
topic yourself. You're good to go.
All right. My name's Connor Hogan, and me and Chris did our article was grocers, restaurants. What does it say?
Oh,
Benefiting from hedging prices of beef, pork. The goal of our presentation today is to learn what hedging is and why, when, how it is used. We look at Costco and Jack in the Box engaging in meat futures as an example of futures. This is our table of contents and what we will be going over. What is hedging? What are futures? Costco and Jack in the Box futures, rationale for futures, and risks of entering into these future contracts. So first off, what is hedging? A hedge is an investment to reduce the risk of adverse price movements in an asset. Hedges,
That could go either up or down.
mm-hmm.
Okay.
yeah, either one. Hedges consist of taking an offsetting position in a related security or underlying asset. Hedges protect the seller or investor from price fluctuations that might hurt their purchasing abilities of these assets. And this is important in various different industries because, like, for example, in the meat industry or like the metal industry, the price swings are so intense that you almost need to have one of these forward contracts put into place so you don't get kind of screwed by the market, really.
So you're really looking to lock in your profit margin.
Right.
Yep. And we're going to explain a lot more about the mechanisms
Okay.
of futures later.
And yeah.
Yeah, so an example to really describe what hedging is, you have to look into what derivatives are. And according to Investopedia, the definition of a derivative is it's a financial instrument that gives buyers and sellers the right and or obligation to an underlying asset. And it depends on the derivative if it's going to be a right or an obligation, or both. And these financial instruments will derive its value from these assets, hence the name derivative. They derive the value from it. So examples of derivatives will be futures, forwards, options, credit swaps. There's more derivatives, and we can talk more about it, but that can be a presentation on its own. And examples of underlying assets can be like currencies, equities, indices, and in this case, livestock. I highlighted futures and livestock because just to demonstrate how hedging works, we're just going to be talking about future livestock meat futures. Connor?
What is a futures contract? So a futures contract is when both an investor and buyer agree to engage to exchange an asset at a guaranteed price in the future, hence the name futures. Price, date, and quantity of the underlying asset has been agreed upon by both parties. Both parties are obligated to act upon the futures contract. You can't get out of it.
So both sides have to perform.
Yeah, they have to
Yes.
uphold their end of the bargain.
Okay.
The main point of futures is to protect a buyer or seller from market fluctuations, especially in those volatile markets such as meat.
Okay.
Buyers of these contracts include hedgers, speculators, and investors. And in the next slide, Chris will go over an example of what a future contract looks like.
So just demonstrate how futures work. We're just going to take an example of like a farmer selling wheat to a bread maker, just to really illustrate how futures work. So in this case, a farmer is trying to sell a pound of wheat to a bread maker. And just to make sure that price fluctuations don't really affect the bread maker or the farmer, they want to make sure that they can lock into a higher price now when the market price is only at 35. So they're just agreeing now at $40 per pound of wheat. But 3 months later, it turns out that the market price is $45. And even though the market price is 45, it's irrelevant to the with respect to the futures contract because they still they still engage in it, and the farmer still has to sell the pound of wheat to for $40 to the bread maker. So irrespective of the market price, the futures contract still has to be exercised. Unlike like an options contract, which is like a right to exercise, but the futures you have to exercise it. In this example, you can see that the bread maker has saved $5 because they have to buy the wheat at $40 instead of $45. So it protects the bread maker instead of the farmer. This is an example of a long future. If in the future, if in this case, the market price was instead $30, the bread maker would actually lose $10 per pound of wheat. And that would be an example of a short future. I actually attached another graph at the end of this presentation, and you can see it at Appendix A to have a little bit more insight to how the futures works. And hedging in action. So we're just looking into Jack in the Box and Costco. And the article we were given demonstrates how these meat contracts work. So they basically engage in these meat futures contracts. They became a really key tool for these companies after the pandemic has really taken its hold on the US economy. And these prices like exorbitantly soared. And it really helped these two companies really protect themselves from these skyrocketing prices. And we're going to see in a later slide like how these prices really affected the meat markets. The rationale for hedging is because it really protects the company from catastrophes in the economy, such as crashes, or in this case, a pandemic, market fluctuations, and it really, the third point is like the stability of the business. You want to be able to ensure that you can be able to provide stable cash flows and sustainable profits to investors instead of being unsustainable and uncertain. You rather be like a really stable company like Apple rather than like an unstable one like Tesla. So that way you can have more investors invest into your company. But also you want to be able to not just go 100% into these futures or hedging positions, as it could lead to huge losses or huge gains, despite the potential for huge gains. To really demonstrate like just how much futures can protect investors, you can just see how much the prices has really changed throughout the pandemic. On the left side are the meat prices in 2018, 2019, 2020, as well as a 5-year average of these meat prices. And you can see that in 2020, it skyrocketed. And we can see the cause of it is because on the right side, you can see how the production of meat has gone down significantly by like nearly 30%. So if you use just general macroeconomics here, if there's a shorter supply, that means there's going to be, higher demand. So therefore higher prices of these meats. So that's why there was a corresponding like 25 to 100% increase in these prices. And in the article directly, it said that the price of the pork belly per 100 pounds swung from around $40 in April to over $200 in mid-May. Just to demonstrate.
Let me just make sure I understand this. So if I'm Costco,
yeah,
I have bought futures around that $40, $45 per 100 pounds.
Mm-hmm.
Now, that would have locked in my price, so that means the price to my customers could be fixed because I'd lock my sales price would be locked in.
Yeah. So
but if I didn't hedge, I'd have to buy it at almost $3.10 per 100 pounds, which means the price to the consumer would have gone up tenfold.
Right.
Okay. Well, do you think I would have been able to put a tenfold increase in price through at Costco?
Probably.
I didn't understand the question. Say again.
Go ahead.
What was the question?
I didn't understand the question. Sorry.
Do you think if I hadn't hedged, I would have had to buy these pork bellies at $3.10, I would have had to increase the price to the customer by about tenfold.
Yeah.
Would have that gone over well with customers?
Oh,
Would have I sold as
absolutely
many?
not, no. Customers would probably go to your competitor, Walmart, or
If they hedged. If
Yeah,
nobody hedged, then that's what we're going to pay.
yeah.
Okay. And if we were looking at the historical trend, we could have never imagined that it would hit this high.
No, so in this case, I don't know, I forgot if we put talking in a future slide, but these companies usually hedge in like months in advance. So they really insulated themselves from this huge hike in the the prices of these meats.
Okay.
Connor.
All right. So risks associated with entering into forward contracts. One risk is that when you enter into the contract, the price of the good may decrease. And this would mean that you would be paying more to your supplier than what the actual market price is. And typically you cannot get out of this either because there's usually a volume requirement. So you need to buy a certain amount of the good until the contract is up, and then you're free. Another risk is you will be forced to pay a higher price than your competitors for however long the contract is. You may not be able to lower prices in order to keep up with the competitors. So if your competitors, they didn't hedge and the market price for the good went lower, then they would be able to charge the consumer a lower price. And if you're not able to do that, then it would hurt your business. And then the third risk is you may not be able to take full advantage of market prices changing in your favor. And that again is just not being able to get the lowest price for the good.
So this is really all about reducing risk.
Right. Yeah.
Next slide.
Yeah. So in the articles that we read, all of the companies, they did not engage in price locks of 100% of their meat supply. And I'd like to get your take on this, Professor, but I believed that they didn't do 100% because they would want to take advantage of when the meat prices sink, even if they get to take advantage a little percentage point. And if they were locked in at 100%, that they wouldn't even have the option to do so.
Yeah. I think it's balancing risk. And let me just give you the other example is when I would be 100% hedged is if I had a contract to deliver, say I had 100,000 pounds of pork bellies. If I had an agreement to sell them to a contract with a customer to deliver 100,000 pounds of pork bellies at $45 a pound, I would clearly hedge the entire position.
Yeah.
Because I would lock in that $5 spread.
Right. That
now,
makes sense.
I want to take on some risk because if I don't have, let's take the same $45 price. I may think there could be some movement in the underlying, price, but I'm not 100% sure. So maybe I'll hedge half my position. So I'll take some risk, but I'm not going to take 100% of the risk.
Yeah, not enough that you'll lose money on the deal.
Correct. If I didn't hedge at all, then I'm totally exposed to whatever the market price is.
Yeah. Okay.
So I don't want to necessarily be 100% exposed because that gives me a bigger risk. If I have a fixed contract, a delivery contract, I would lock it out. Now, you got to take a look at that from the other perspective is if you don't have a fixed contract. Okay. So if you don't have a fixed contract, you have to go back and look at what has been the impact of changes in the underlying commodity in my retail price. So if I'm pretty sure I can get a 5% margin and always add 5% on no matter whatever the market price is.
Yeah. That's
I wouldn't.
probably even more so like in the steadier
Yeah,
industries.
yep. That I'm willing, if I can get the price to stick, that's okay. So if I can always increase it by 5%, whatever the underlying price is, I wouldn't hedge as much, but I'd have to hedge a portion of it looking at the time the supply chain works. So if I'm Costco, and let's assume that by the time I order a product, it's delivered and in the stores is 60 days, okay? I got to protect my margin in those 60 days.
Right. Yeah.
So you're going to play with that to do that, and that's a balance because you don't want to leave profit on the table, but you don't want to expose your risk. Now think about it from a farmer's perspective. If that farmer can get $40 and that's going to cover all of his costs and profit, he may want to do that too, because it's going to lock in his profit. So if we're looking at this whole supply chain thing, hedging can be very, very effective.
Yeah.
Conversely, it could be very painful depending on what's happening.
Mm-hmm.
Okay. And I still had a few things.
Oh, sorry.
In the article, it said that some of the companies, they need to find a sweet spot between the contracted price, the market price, and operating costs. And this way that they will be protected from product price swings and operating cost swings.
Sure.
And they'll be able to balance each other out in order to find the optimal price for both the company and the supplier. So they both make it out with some profit.
Okay. What company are you using for your project?
We use Costco and
Jack in the Box.
Yeah.
Yeah, but for your application project, what are you working on? Chris, yeah, we'll start with Chris. What company are you working on?
Oh, we're doing McDonald's. Oh, I forgot for a second. I don't know why.
Okay. Great. Austin, which company are you working with? Speaker.
I'm muted here. I actually haven't started it yet. I'm starting it right after this gets wrapped up.
What's the name of the company you're working with?
I'm honestly not sure yet.
What'd you work on in Project One?
Oh, in Project One, we're doing the same. I did the Home Depot.
Okay. What could Home Depot hedge?
I guess, certain prices on maybe like wood they're getting from their suppliers.
Okay, sure. Lumber. Sure. Lumber. Olivia, what are you working on? Which company?
I'm also doing Home Depot.
Home Depot also. Tanner?
I'm doing Every.
Oh, yeah. Do you think they could use hedging?
Yeah, maybe with the slot machine technology and like the infrastructure of that.
Okay.
What company is that?
They make these slot machines for like all the casinos. So they have like a high market share in that, but they're struggling right now because of the coronavirus. No one's going there.
Are they doing anything off track? Are they doing anything virtually?
Yeah, they're doing cashless technology. So they're putting in like ATMs where instead of like a debit card putting it in and getting cash out, you put a credit card in and then you get like a voucher.
Okay.
So they're transitioning with the whole coronavirus with no cash to.
Are they creating anything that would add to online gambling?
No, I don't believe they. I was actually listening to their earnings call. Somebody asked a question about that, and they said that they're looking into it, but they didn't really have like a definite answer of what their outlook on it would be. But that's definitely a big sector that they should look into.
Okay. Other thoughts?
Oh yeah, I have a question for you guys. With the whole futures and everything, what happens if a company locks in a price at a disadvantage price, and they can't like afford to pay it?
Mm-hmm.
Yeah, that's so
I had this on Appendix A in case someone had a question like that. So were you asking for? Like, we lock in a price now and the market price is lower or higher in the future?
If you lock in a price now and you're the supplier and the price
Yeah.
goes down, do they have to pay that first before they can supply their other contracts?
Uh, do you have to pay that first before they supply contracts?
So
I think so.
say they
I
40 and then it goes down to 36. They lock in another contract at 36. Can they use the 36 to pay the 40 first?
Oh, I see what you're saying.
There is a margin requirement.
Hmm.
But yes, if I had a 40, could I buy a 36 to offset it? Yeah. Offset it, but I still got my $4 exposure there, which I'd have to keep a margin on.
I think that's what's called a box. This isn't options, but like in options, I know they do box spreads. Like they have calls and puts to like balance it out. But like I'm not sure if it works in futures trading. But I think you can. I'm not
It's very
sure.
similar.
Mm-hmm.
It is okay. So yeah,
Very
there's
similar.
box spreads. Yeah. Basically yes. You can do what you just said you wanted to do, like buy 40 and 36 contracts, and the market price is 38. It goes up. Yeah.
Yeah, but they're definitely still on the hook for the 40. So
Yeah.
Then it cancels out. Yeah.
Yeah. They can be very, I think you have if you're a company using them to hedge, they generally work in your favor. But there's also other market participants other than hedgers. And there's other people who will go out and say, I think the price of pork is going to go up with this pandemic. So early on, I might buy some futures at 40 because I think the price is going up. I'm speculating. And in that case, the speculators create liquidity. Coming back to this whole discussion of liquidity that we talked about earlier, this is also about liquidity too. And that's what happened if you go back. Remember what we had, it was in May when we had negative oil prices. If you remember, oil prices went negative.
Oh yeah, the contracts, the futures
Yeah.
contracts.
Mm-hmm. Absolutely. So it has its pros and its cons. Questions? Good discussion. Anything else? I thank everybody for being here this morning. I think that, let's see. Let me just make this sure everybody is here. Connor, you've got your 3 done, right?
Yep.
Chris, you have your 3 done.
Mm-hmm.
Olivia, did you stay for 2?
Yeah, I was here for 2.
Okay. Tanner, 1.
Mm-hmm.
Austin?
It should have been my 3rd because I just did 2 today. I did 1 the other morning last week.
Oh, yeah. You did the retail reckoning?
Mm-hmm.
Okay, so you're 3. So Connor's 3, Chris is 3, Olivia's 2, Tanner's 1, and Austin is 3. And Patrick was here for, did he stay for both of them? No, he just stayed for 1 extra one. No, he just did the one you did.
Yeah.
He's single, so he doesn't. Okay, super. I thank everybody. For those of you that are done, great. Olivia, you got 1 more to look at. I would suggest looking at retail reckoning.
Okay.
Okay, I think that's a good one to look at. Tanner, I'd say the same to you. This retail reckoning is really an interesting concept because I think it's some fundamental changes. And which one of this morning would you say, Chris or Connor, which one of the early ones this morning would you say is the one to really watch?
Right now, I think that our airline discussion before everyone else hopped on was
good. Yeah. Then look at the first one for
everyone should be
today.
watching that, really.
Yeah. There was some good discussion around the airlines. Yeah.
I really enjoyed the airline discussion, especially at the end when we were looking at the balance sheets of like
Yeah.
here. I really enjoyed that one. Yeah.
Good. So take a look at those. We'll be done. And then with the remaining things are the quiz is on the 18th. Suggestions on how I should make the quiz?
Or multiple.
True, false.
Well, think about that for a second. Before you ask for something, think about it.
Opinion questions.
Okay. Well, but you were fast to do true, false. Why were you doing true, false?
50-50.
50-50 chance.
You hedge your bet.
You're hedging your bets.
Hedging.
But you could be wrong, or you could
I'm
be.
learning.
There's no grit. That's a good thing, Connor. Learning is important. But there's true, false can be very deadly.
Nah, not really.
Okay, I'll make a true, false for you, and you can see how it goes. Multiple choice, opinion, figuring things out. How can you best hedge your risk?
What?
I'll think of something good. Just ask a totally random one because we're going to do this, I think. Do you ever have an oral test?
Moral?
Yeah.
Oral.
I've never.
In like Spanish class.
How'd that go?
Pretty smoothly.
Okay.
Oral test will be interesting.
That will be interesting.
Yeah, I don't know how to do that. We're going to do. I think I'm going to do it in organizational behavior because it's a little. Concepts are easier. Not easier. They're different.
Mm-hmm.
In finance, they're very specific. Let me think about it. No, I don't think we don't have enough time to do that. Maybe next semester. And Tanner, that'll work for you, right? Because you're doing Smith-Flet next semester. Did I
Yep.
get that right?
Yep.
Okay, good.